welcome to the demonstration video for our valuation tool. In this dashboard area, you're going to see two sections. One is for business valuations and one is for comp searches. For the business valuations, you have two areas to start a valuation. One is to the top left where it says add new valuation. The other is to edit an existing valuation. In this case, we're going to be editing an existing valuation only because we don't have to add in the numbers. We're going to go ahead and click Edit an existing valuation, and that's going to take us to step 1 of 6. The step 1 is the setup area, and in this particular case, it's focused primarily on the operations of the business. The most important area is going to be the NACIS code. We can either add the NACIS code in directly, or we can click the search button. It's going to take us to the tree. And from here, you can pick the NACIS code that fits the best of that business. We're also going to add in the last full year analyzed, number of year in business, the analyst that's focusing on it, and then the last section is going to be the positive and or negative factors of this business. And keep in mind, these are simply going to be posted in the report. They do not impact the value. They're only going to be posted in the report. So as you work through, they all don't have to be positive factors. Some can be positive, some can be negative. And then at the very end, you're going to see a box. It says Set Up Notes. At the end of each step, you're actually going to see a box, and this is a good way to put your notes down. You're not going to see this in the report, but you will see it in the Edit tool. This will give you at least an idea of why you're making certain assumptions as you're going through the valuation. If we click Next, we're going to it'll take us to the Asset section. In the Asset section, you're only going to be adding what assets and what liabilities are actually included in the value, or in this case, the sale. So in this particular model, we're making the assumption this is an asset sale. So an asset sale typically is going to include only inventory, fixed assets, and goodwill. If this were a stock sale, we would then add the cash from the latest balance sheet, the receivables from the latest balance sheet, and then also any liabilities from the latest balance sheet, or again, whatever is included in the sale. We do have an inventory section. The inventory section is broken down into two areas. One is going to be normal operating inventory. The second is going to be excess inventory. There are some industries where there's going to be seasonality, and if you are valuing that business during a high season, that business may have some excess inventory. So at that point, we would put the normal inventory in the normal inventory box, and then we would add in the excess inventory to take in consideration any seasonal inventory or excess inventory. Fixed assets are typically used at book value, or if you do have an appraisal or a very good idea of what those fixed assets are worth, then you would add the appraised value. We are not going to add in things like real estate or goodwill. Real estate is not part of the business and typically is valued separate from the business. And then goodwill is going to be valued as we go through this process. So in this particular case, you're not going to add in intangible assets or goodwill. If we click Next, this takes us to the income side of the valuation tool. In this section, we're going to be focusing on 3 years of financial performance and then a projected year. So there's 4 columns here. We're going to add in our revenue, our pre-tax profit, our depreciation, interest, which we would call our EBITDA, and then we're going to utilize our add backs. In this particular case, officers' compensation, officers' benefits, or what we would call perks. If there are rent adjustments, this is where you would put these in the rent adjustment section. We've added a few different lines here for other add backs. So these may be add backs that aren't included in rent, perks, benefits, and compensation. So we've given you the ability to add in your own add backs. And what we've done here is added personal vehicle. 1 year there was a net gain on assets. And you have the ability to make these positive or negative. You then get to a less economic replacement salary. So in this case, whether you put it in positive or negative, it's always going to enter as a negative number because it's a replacement salary. Keep in mind that's an economic replacement salary. That would be not what the possible buyer would take. It would be what you could hire someone to replace the CEO or owner of that company to run the day-to-day management. At the end of the income section, you have your confidence level or weight section. In this case, what we're trying to do is figure out what is the most reasonable projection going forward. So we know we have 3 different columns and a projection, but what we're trying to do is actually create a projection in our first year. So we're looking at our columns as traditional cash flow base at 100%. So I've added 25% in years 2014 and 2015, and then I've given most weight to 2016. If I recall, this projected year was an annualized year based on only 3 or 4 months of information. So I decided that I would not weight that 4th column or 4th year. So once we add in our weights, we now have our weighted seller's discretionary earnings and our weighted EBITDA. The only difference between seller's discretionary earnings and EBITDA would be the $150,000 economic replacement salary for an owner-operator. So that gives us our base. That is using the historical financial statements to give us the base of what we're going to work on going forward. So now that we've got our historical base, we now have to add our growth rates for year 1, which would be, let's say, 2017, year 2, 2018, and so on and so forth. One quick note, if you mouse over the question marks, you're going to get hints on what to do and how to use that particular section. So in this particular case, it says, first year could be based on annualized calculation from the interim or an actual projection. Growth rates can be negative as well. So we've added 5% growth in our first year, 4% growth in our second year, and then 3% growth there on out into perpetuity. Again, our notes at the very bottom, the notes that I have here say only 3 months of interims for 2017, focus primarily on 2016 and split the weight between 16 and the 2 previous years. You have the ability to add notes. I think the note section is a good tool to be able to focus on your assumptions, and so you can go back and know exactly what you were thinking on the weights that you used and some of the add backs that you were using. If we click on next, it'll take us to the risk section. In the risk section, we're focusing on building a cap rate. A lot of you would also look at this as a multiple of cash flow. The cap rate is the multiple, is the invert of the multiple of cash flow. So let's say if you have a 25% cap rate, 1 divided by 25% gives us 4 times. That'd be a 4 times multiplier of cash flow. The neat thing in this section is you can simply glide and move the arrow to the low risk and high risk section. So as you move to high risk, the cap rate goes up. So if you can see, it says 38% here. If we put it at a lower risk, it's going to bump it down to 21%. So it's up to the analyst to read the financial section risk and kind of gauge based on the historical financials of the company of how much risk the specific company has. In this particular case, I think I used an average risk. Quality of financial information. If you have audited financials, they may be less risky than, let's say, internal financials. So we also look at quality based on the number of adjustments or add backs that are used. The higher amount of add backs that are used, you would make the assumption that it creates concern and risk to a buyer who may not agree with some of the add backs. So in this particular case, there weren't too many add backs. I think it was average to maybe even below average risk. Diversification, this would fall under customer concentration, a supplier concentration. In this particular case, I believe the company had one or two main customers that represented a large portion of their sales. So we've given it higher risk. Management risk is how dependent the company is on the owner of the company or a key employee. For instance, if you've got a doctor practice and the doctor practice or physician's practice um, is solely reliant upon one physician, one medical doctor, there's going to be a lot more risk in that practice versus a dental practice or a medical practice that have multiple doctors. In this particular case, we have an owner, but there are also key managers in place, so we have a little bit lower risk. The last two, industry risk and competition risk, are pretty self-explanatory. The industry risk, the analyst should go out and do some due diligence on the industry and see what the growth rates are and what the risk would be in that industry. And then competition may not be exactly what it seems. I look at competition as if you are already competing with multiple competitors in an area and still performing well. I would think that would be lower risk than having no competition at all, but in an area that's ripe for new competition. So definitely look at your competition both ways. Again, at the very bottom here, we've added our notes for our cap rate. Once you develop your cap rate, you're not going to see the final cap rate here, but it's going to take an average of all the cap rates for each risk factor. And then it'll calculate that into a total cap rate. So if we hit next, we're going to take us to step 5, which is our market approach. For some of you who have watched the other video about comp searches, you'll know exactly what to do here. In this case, I'm going to do a quick demonstration on how the comp search works. There are two different ways. One is if you've got comp searches created already, you can scroll through your dashboard and click on a specific comp search that you've already created. Or you can create a new comp search. In this particular case, I'm going to go ahead and click manufacturing. I can click on metal tank, or let's do something with more comps in it, sheet metal work manufacturing. I can then filter by keyword or state. In this case, let's go ahead and filter by size, and we'll do anything at 2.5 million to as high as 10 million in sales. And apply the filter. Now we have 5 comps. View the next step. All the comps look good. I'm going to save the search. I'm going to put in sheet metal, and then let's just call that sheet metal. And then there's our comparables report. And then also it shows sheet metal in our comp search and the multiples, the price to revenue multiples, price to seller's discretionary earnings, and price to EBITDA multiples. So if we wanted to keep it at sheet metal, we could, or we can go back and focus on metal building manufacturing, which was the original. So I'll leave it there. Again, we want to make sure that we put in our notes what comps you used and why, and then finally what method we weighted and why. This particular method, the market approach, gives us 3 areas to focus on. One is going to be price to revenue, the other is going to be price to seller's discretionary earnings, and the final one is price to EBITDA. And in this case, we are not focusing on revenue. We're going to focus on the 2 cash flow methods, so we've weighted each of those 50%. If we click next, we get to the final stage and the final step, which is the reconciliation. These are our 3 different approaches: the asset approach, the income approach, and the market approach. And it shows what the value is. and then our notes area. And in this case, I've focused primarily on the income approach because of continued growth, and the income approach being a discounted future cash flow model. The second approach is the market approach, which I've only weighted 25%. And so now I'm going to go ahead and finish the report. And if you create a new report, it'll ask you to name it. Because I edited this one, it's just going to take me straight back to the dashboard. So now I have the ability to edit further, or I can view the report. To view the report, if I click Valuation Report, it'll take a minute or two to create the PDF. It's a relatively large file. So now we have our, which I believe to be about a 15-page report in PDF form. And the report itself discusses the purpose, the key terms and definitions, the information about the company that you put into step one, which is the setup page, the risk section, as well as the financial section. You work your way through the financial section to the valuation section, and each method is clearly defined and explained and works through the calculations. And then as we work through our income approach and our market approach, we end up at the reconciliation of values. And this shows you exactly the asset approach, the income approach, the market approach, the confidence levels or weighting that you applied to those. And then at the very end, it breaks out the final value, plus it shows you the intangible value or the goodwill within the company. And then there's a few exhibits at the end. If we, at that point, scroll to the first page, you can print, save, send it to a colleague. You're always going to have your dashboard back to edit. If you wanted to edit the report, you can always go back and edit. It'll take you to the last step that you ended, in this case, the reconciliation section. If you wanted to go back and edit the cash flow section and add some add backs, you can certainly do that. Anytime you add something in and you click next, it's going to go ahead and save that. And then you can always go back to your dashboard and reprint the report. That concludes the video demonstration for the valuation tool.